I'm being joined by Shweta Dabtardar, Vice President, BFSI Elara Securities, and my colleague Harsh Sayata will be partaking in this conversation too. Welcome, Shweta. Thank you so much for giving us your time. Let me set the stage for you by asking, yes, a repo rate cut is good from the sense of easing liquidity, but how could this affect the margins of major banks, and who would this impact the most? Shweta? Shweta, can you hear me?
Yeah.
Okay, no issues. Harsh, why don't you give us a sense of what are the implications of a rate cut? Yes, a rate cut is good, and when the RBI's governor was giving his speech, he mentioned that he is cutting these rate cuts to ease liquidity because there's a slowing GDP growth as well. But we've gotten Shweta back, and Shweta, are you with me now?
Yeah.
Okay, amazing, Shweta. Thank you so much. As I was asking you, a repo rate cut is good from the sense of easing liquidity, but how could this affect the margins of major banks, and how would this impact, who would this impact the most?
Okay, clearly having
Okay, yeah, no problem.
But okay. So while they fix that, quickly onto your question.
Yeah.
So yes, a repo rate cut would likely has already in fact translated to deposit rate cuts at lots of major banks.
Correct.
We've seen ICICI, Axis, HDFC, and an SBI even come out and say that they've cut the deposit rates. So one is you'll start to see deposit rates come off. And you'll also see loan rates come off. So any external benchmark loan rate should ideally be coming off by 25 to 50 basis points already. MCLR, which is more linked, and that's again another type of linked loan, that may take some amount of time to come off as the cost of funds of various entities start to come down. But the immediate translation will be deposit rates coming off. The other immediate translation will be NBFCs benefiting from a lower cost of funds. Both of those should translate pretty much quickly.
Sorry. Oh, Shweta is back again. Let's try again. Shweta, can you hear me?
Yeah, I can hear.
Okay. So Shweta, as I was asking you, and this is my third time, I really hope that you get my question now. How do you think the repo rate cut is going to affect the margins of major banks, and who is this going to impact the most?
Yeah. So I'll touch base on NBFCs because that's where my expertise and forte lie. So as far as 50 bips repo rate cut is concerned, it is determined by three factors. So one is fixed versus floating rate loans as far as NBFCs are concerned, then funding mix, and lastly, the way these NBFCs can transmit these rate cuts. So NBFCs factoring in 50 bips repo rate cut, the ones with fixed rate loans, say for instance, Bajaj Finance, SBI Cards, Cholamandalam, these will see stable yields and lower borrowing cost. So any NBFC with fixed rate loan book will benefit in the near term as far as rate cuts are concerned. And NBFCs with floating rate loan book will have a certain lag and will see certain pressure on net interest margins in the interims. But effectively, a 50 bips rate cut will definitely translate into over 20 to 40 bips kind of cost of fund reduction for NBFCs.
And Shweta, Harsh also joining in. How much of that will translate or get transmitted in your understanding to the consumer? Because that's the other thing which the governor has alluded to.
Yes, so as you rightly mentioned, there has to be transmission that has to happen through yields. And I think we are already sort of getting there with banks already beginning to cut their deposit rates. We are also expecting and hoping it will flow through and transmit through lending rates as well. But we have to be cognizant about a couple of factors here. One is we know that we are coming from a scenario where risk weightages had turned higher for NBFCs. But alternatively, on the positive front, the liquidity constraints, the liquidity scenario is sort of turning in favor of NBFCs. So although risk weightages had risen, but given the fact that liquidity scenario is supportive and juxtaposed to that repo rate cuts, I think that definitely bodes well for NBFCs as far as their funding scenario or funding situation is concerned. So I think if the funding scenario is slightly turning favorable, then highly likely we'll see transmission also happening through yields. So ultimately, the consumer should definitely benefit. As far as, like I mentioned even earlier, in the interim periods, you will see consumer loans, consumer durable loans, personal loans, vehicle loans benefiting more from the rate cut scenario.
Point taken. And Shweta, what about the outlook from an asset quality perspective? What's playing out? You're seeing some spikes in certain NBFC counters, microfinance in particular. It seems from a stock price perspective seems to have bottomed to a certain extent. What are your checks indicating both on microfinance? And I also want to highlight that in December 2024, Ilara, you guys came out with a report and suggested that CV might also be under some bit of pressure in quarters going ahead. Any concerns on any of these books, and how do you see it play out?
Yes, so lead indicators definitely are building in a slightly positive scenario as we usher into New Year. I mean, we are already into New Year. But having said that, while headline buckets, so say 30 DPD, 90 DPD, headline GNPA still or headline delinquencies still remain on the higher side. But the good news is the forward flows or the delinquency flows into NPA pool into write-off pool is definitely substantially declining. So that is a positive indicator in terms of anticipation of lower slippages, and therefore we have started building in slightly modest credit cost going forward. Coming to sector-specific scenario, so as far as microfinance is concerned, clearly the recovery is still 2 quarters away. Perhaps H2, beginning of H2 of FY26 fiscal will be a better, perhaps will provide a better picture on how things are turning around on asset quality front for microfinance. For now, delinquencies continue to remain elevated, although there has been improvement in collection efficiencies. But then it's too premature to sort of build a positive scenario there. CV financiers, you're right. We did some channel checks pan India, which are alluding to the fact that bounce rates or early delinquencies still remain on the higher side. But the growth scenario, so as far as vehicle finance growth is concerned, is slightly tapered. But growth scenario, as far as home loans, LAP, consumer loans are concerned, so there we are building in strong growth targets. So I think diversified NBFCs, even though likes of Chola, Shriram are CV focused, but their non-CV portfolio is going to drive growth. So definitely net scenario looks pretty healthy in terms of growth. Asset quality concerns remain, they still linger. But yeah, as we have entered into a scenario where incremental flows are curbed or have
Right.
been under control, so I think it paints a positive picture going forward.
Right, Shweta. Thank you so much. A positive picture overall, although asset quality remains a concern, but we're hoping that that eases down soon as well.